Hi everyone, I'm Paul and welcome to my review of ICT's 2022 Mentorship Program Lesson 5. I've been getting lots of great feedback out there from everyone on this series of videos, so thanks very much for commenting if you have. I reply to everyone. Please keep liking and subscribing to the videos, that helps me to grow this channel. And if you do subscribe, just let me know in the comments and I promise I'll respond. So with that out of the way, let's jump into today's video. So today's video is lesson 5 of the 2022 ICT Mentorship Program. And we'll just start with a brief outline just as we do with each video. So the first part of the video will be a section on understanding index futures. And then we're going to go through the components of the Intra-Day framework that ICT's been teaching. So just breaking down each of the sessions and what our intent is in each of those particular sessions. And then we'll finish up by unpacking that Intra-Day framework and using 2 examples as a case study. So using the E-mini S&P from the 1st of February as a case study for the morning session, and using the NASDAQ from the 1st of February as a case study for the afternoon session. So starting off with understanding index futures. So you'll note from the course so far we've been using the E-mini S&P and the NASDAQ as the main instruments throughout the mentorship program, and the codes for these are the ES for the S&P and the NQ for the NASDAQ. So index futures are traded quarterly, and these are what we call the delivery months, and because they're futures they obviously expire, and so index futures expire on the 3rd Friday of the actual delivery month. So we have 4 delivery months: March, June, September and December, and they each have their own unique code. So March is H, June is M, September is U, and December is Z. And this is all important because it helps us to understand the symbol, so the nomenclature for how you create the symbol for index futures. So it's quite simply the code plus the delivery month plus the year. So if we're going to use the E-mini S&P December 2022 contract, that's simply the code being ES, the delivery month being Z, and the year being 2020, so that gives us ESZ 2022. So you can type this into TradingView or most trading platforms or charting applications, and this will give you the chart for that particular delivery month. Now, the thing you can also do if you just want to look at a continuous chart, and this is what you do in TradingView, I'm not sure how it would work in other platforms, but in TradingView you just type ES1 exclamation mark if you want to look at the continuous chart for the E-mini, and then the same for the NASDAQ. You just type NQ1 exclamation mark and that'll give you the continuous chart. So that's basically just, all those front month, all those delivery months just all mushed together into one continuous chart. So I just mentioned front month, and so front month refers to the current delivery month. So that's the month that's currently being traded, and this is also called the near or the spot month. It's just a same term for the same thing. It just basically means the contract that's being traded at the moment. And this is important because the front month is generally the most traded. So that means it's just going to be more liquid, and this is going to be attractive to traders just because obviously easier to get in and out. It's where the most activity will be. And you can ascertain this by just looking at the open interest for each delivery month. So what you'll generally find is that front month primarily is going to have the most open interest, so it's going to be the most liquid. And then obviously as you get closer to expiration, that 3rd Friday in the month, you'll start to see more activity in the next month. So moving on now to the key components of our intraday framework. One of the key parts of the trade setup that we're being taught by ICT is that we use New York time as the reference point. And so you can set this as your default in TradingView if that's the trading platform you use. And this is just makes everything much easier because ICT is always referring to New York time whenever he uses, a timestamp in his teachings. Basically, the day gets broken down into 3 sessions. You have a morning session, a lunch session, and an afternoon session. That morning session goes from 8:30 till 12, the lunch session from 12 to 1, and the afternoon session from 1 to 4:30. So one thing to keep in mind is that the lunch session is a no trade zone, and that's just because a lot of funky things can happen in that particular part of the session, and so it's just best to avoid it altogether and just focus on trading the morning session as one particular session and then the afternoon session as a separate session. So our aim is to be positioned prior to 11 o'clock in the morning session, and ideally we're only looking at trading that morning session. ICT at the beginning of the mentorship program spoke about only teaching that morning session and not teaching the afternoon, but he's decided to include that in the training as well, which is really great. And so if we were going to trade that afternoon session, we'd aim to be positioned so in our trade before 2:30 in that part of the session. So for the morning session, we're looking at swing highs or swing lows prior to 8:30 as our trigger for entry. And for the afternoon session, we're looking to swing highs and swing lows at or after 1:30 as our triggers for our entry for that afternoon session. And so it's helpful to think of the trading day as having three distinct sessions. So there's going to be a morning move, a lunch period where we won't be trading. We may trade through that, so you could be set prior to lunch, but not actually take any trades during that lunch period. And then there's an afternoon move. And so because there's these distinctly different sessions, a morning session and an afternoon session, you can obviously have multiple combinations in the same trading day. So you could have bullish continuation, where you have bullish morning session and a bullish afternoon session. You could have a bullish morning session and then a retracement, so you have then a bearish second session in that afternoon. You may have a bullish morning session and then a consolidation, and so on. So all those combinations are possible, and you obviously just have to trade them accordingly. So the first case study we're going to do is with the E-mini S&P, and this is for the case study for our morning session. If we look at the setup here, so this is the 1st of February, and what I've done here is I've broken up the day into each of these sessions. So you can see, if I just draw this across here, this is 8:30. This blue section here is the lunch session, so this is where we would not be trading, and then obviously the end of the session is out here. Remember, if we're trading the morning session, and we're just looking at really the morning session for the S&P in this part of the case study, is we're actually looking prior to 8:30, so this is 8:30 here, and we're looking at swing highs and swing lows as our reference points or our triggers for our entries as we go into that morning session. So remember, our swing high is a 3 candle pattern, so the center candle should be the highest of those candles. So you can see that here. Just zoom in a little bit more. You can see that here. This candle has the highest high, and each candle on each side, the high is lower. So that's our swing high pattern there. So I've obviously just marked this out and then run that through into the session. Obviously looking at this session in hindsight, you'd do this as you were going into the day session. And then similarly with the low, we've got the same pattern here. So we have this swing low here, and again it's a 3 candle pattern, so the center candle has the lowest low of the 3 candles, and each one beside it is lower than that one. So you can see this is quite close, but it's still the lowest of those 3 candles. And again, I've just marked this up to the side. So remember, this is where our liquidity resides, above this level. So in this instance, you would have traders going short at these levels, and they would be putting their stops, their protective stops, above that. So they're generally going to be buy stops at markets. They're going to be orders that trigger once the market trades above these levels. And conversely, at the lows, we have liquidity. And again, we would have traders here going long. They would use the low as a reference point, have their stop residing below that. Because they're long, they obviously need to sell to close out. So they have their sell stops residing below those points. And so we can see going into the morning session after 8:30, the market rallies up and it doesn't quite breach this previous high. Now, ICT talks about this 3 drives pattern. And so what that looks like is, if you look at it here, you can see there's these 3 consecutive moves upwards in the market. So I'll just mark them here so you can see these 3 swing highs. So there's the first one there, and the second one here. Sorry, that's not the best drawing in the world. And then the third one there. So this is what's called a 3 drives pattern, and this can reside on any time frame. So we're looking at a 5-minute chart here, but you'll notice these 3 drives patterns all across different time frames. So on any chart you can see this. And basically what's happening is the market is driving higher and higher, and each time it goes higher, it's taking out the liquidity before. And so that's why when you see this 3 drives pattern, it's not a requirement that this particular high breaches this one, because we've just had this build up of liquidity as the market's driven higher. So in this instance, we have the market drive up. You can see it's had this big displacement down prior to this big candle here. So IC2 talks about displacement, and you'll notice if you've been following the videos and we talk about these fair value gaps, is we often have this quite powerful move in this candle which forms the fair value gap. And so The fair value gap in this example is just here. Just mark that up so you can see it's just there. So again, it's always a 3 candle pattern. So there's the first candle, the second candle, and the third candle. And the fair value gap resides between the low of this first candle and then the high of the third candle. And it crosses the body of the second candle. And you can see that second candle, it breaks market structure. So we have this candle here. So there's this low here. And this candle creates a new lower low. So we have that break in market structure here. And then the market trades back up into this fair value gap. So let's pull this across. So you can see in this instance, there was a number of opportunities to get set with this particular fair value gap setup before the market traded lower back into these sell stops, back into this liquidity later in the session. So if I just mark this out, this isn't really a high return trade. I think it's probably just under maybe a 2 times return. So if we just mark that up, you can see if we'd set our exit down here at the swing low, it's about a 1.5 R return. So that's not too bad. That's still a nice trade, and that's obviously happened in quite a short period. So you'd be in maybe this candle, even this one, or even if you just got in on this one, you're in and done in 5 minutes on that trade. So that's quite a good turnaround. Now, in this example that ICT is using, he's actually intending to be bullish. He has a bullish bias for the actual session. And so there'd be the opportunity to potentially get set at these lows here. So now that we've taken out these sell stops, because remember, often with these setups, you'll have the market move in the opposite direction first before going down and then going up again. And so that's what's happened here. If we just drag this across, you can see prior to the lunch session, there'd potentially be the opportunity to get set down here in this, as the market goes down and grabs this liquidity before the market drives higher over the rest of the session. So our case study for the afternoon session is using the NASDAQ on the 1st of February again. And you can see here I've got the day session marked out, so 8:30 all the way to lunch. So this is obviously our no trade session. We're looking just specifically at the afternoon session. So we're on the 15-minute chart here, and you can see we have these equal lows forming around 1:30. This is where our liquidity is going to reside, and this is obviously sell stop. So we would have traders potentially going long here, and they would be setting their stops, and then the market drives through into that liquidity before that move higher, running into the end of the session. Now, if we zoom in on that and we look at a tighter time frame, so we're going to go from 15 and we're going to go down and look at the 4-minute chart, you can see this in even more detail. So we have these lows here, so we have the swing low here, and then we have these consecutive lows before this push down into liquidity, which takes out all of these sell stops. And you can see this fair value gaps formed here. So we'll just zoom right in on that. You can see after this push down into this liquidity, so taking out all of those sell stops, accessing that liquidity at the lows, we have this fair value gap formed. So again, it's our 3 candle pattern. So you can see we're trying to get set here before 2:30. So this is between sort of 2 and about 2:30. And our fair value gap is formed between, in this instance, because we're going long, the high of the first candle and the low of the third candle, and that crosses the body of that second candle. So you can see this is where our fair value gap would be in here, and this candle breaks market structure because we're creating a new high. So this high is higher than this one. And if we were looking to go long here, what we would have is we would have our limit at the low of this third candle, or we could potentially be sitting getting ready to trade at market. But as soon as it comes into this fair value gap, we want to be set, and we would have our stop then placed at the low of that first candle. Now I've marked out this actual trade, and you can see that if we'd run this all the way through to the close, there's like a 9R return, or more better than that, which is really quite excellent. So keep in mind though that ICT is teaching about going after that low hanging fruit. So it's pretty unlikely that we would have picked up all of that 9R return. And so what we would really be looking at if we were in this trade, we'd be looking at either fair value gaps, so we'd be looking at bearish fair value gaps because we've had that shift in market structure to the upside. So we'd be looking at bearish fair value gaps, or we'd be looking at old highs where stops might be residing as our way of getting out. So you can see likely candidates we would have is, these initial highs here, and that's still a 2R return, which is pretty good. And if we were, say, targeting, these highs back here, again, that's a 5R return. So anywhere in there is going to obviously be fantastic. And you can see if you would have held, and most likely you would have held till this candle, you would have got the bulk of the return on that candle there. So on the close of that candle, you're still sitting at over a 3R return or 3.6R return. So that again is a really great return and just shows the power of this fair value gap setup if you have marked out your liquidity and you are timing that entry correctly. So there you go, there's my review of lesson 5 of ICT's 2022 mentorship program. So in this video we covered how you would use fair value gaps in the afternoon and the morning sessions. This is the first time we've really looked at that afternoon session, so that's been, I think, really helpful. And we've also introduced that 3 drives pattern, which we hadn't talked about before, and also talked a little bit more about displacement, and that's a fairly integral part of making sure that fair value setup is going to be as effective as possible. If you enjoyed this video, it'd be great if you could like it. That helps other people to find it. And if you're enjoying this series of videos, subscribe to my channel because I'll be doing more videos shortly, and I'll see you in the next video.